Welcome to The Explainer. Today, we are peeling back the curtain on something you might do every day. We're going to follow a single stock trade from that one simple click on your screen through all the invisible, high-stakes financial machinery that makes it happen.
It feels totally instant, doesn't it? You tap buy on your phone and poof, you're a shareholder. But behind that one click is actually an incredibly complex, high-stakes relay race that keeps our entire financial system from falling apart. So the real question is, how does your one tiny trade find its way through a system that's built to handle millions, even billions of transactions every single day? Well, we are going to follow the secret life of that trade, from your screen all the way to its final destination. Okay, so to really get this journey, we have to start with the single biggest problem, the one fundamental risk that every transaction, whether you're buying a coffee or $1 billion in stock, has to solve. It's really, really simple when you think about it. What if the other person doesn't hold up their end of the bargain? In the financial markets, they call this counterparty risk. And look, with millions of anonymous trades happening every second, if that risk isn't managed perfectly, the entire system could just seize up. So how in the world do the markets solve this massive problem of trust? How can you be sure that when you sell your shares, some stranger you've never met on the other side of the planet is actually going to pay you? Well, it used to be that you kind of just had to cross your fingers. Trades were settled bilaterally, which means you personally carried all the risk that the other guy would fail. And if they did, a chain reaction could start. The modern solution, though, is way smarter. It's a powerful, invisible middleman that steps into almost every single trade. And this is the central counterparty, or CCP. Think of it like a universal insurance policy for the market. By stepping in the middle, it becomes the buyer to every seller, and the seller to every buyer. It basically absorbs all that one-on-one risk, so you don't have to worry about who you're trading with. It guarantees the trade will happen, no matter what. This is all done through a really clever legal trick called novation. So imagine the original deal between you and the other trader is just instantly torn up. It's gone. In its place, two brand new contracts are created, one between you and the CCP and another between the CCP and the other trader. That original, risky connection between the two of you, poof, vanished. All right, so with the risk now safely managed by the CCP, we can get to the next critical stage, the actual final exchange of the stock for the cash, the big swap. The entire system is built on this one simple but absolutely crucial principle, delivery versus payment, or DVP. It basically guarantees that the stocks and the cash change hands at the exact same moment. It's like a secure digital escrow that makes it impossible for a seller to give up their shares without getting the money, or for a buyer to pay up and get nothing in return. Nobody gets left empty-handed. And here's the thing that surprises a lot of people. This digital handshake doesn't actually happen the second you click buy. It happens on a very strict, globally coordinated timeline. For years, the standard has been T+2. That means final settlement happens 2 business days after the trade day. But the longer that time gap is, the more risk is just hanging out in the system. And that's why there's this massive industry-wide race to make that cycle shorter and shorter. We've gone from T+3 down to T+2, and just recently, the US markets made the huge leap to T+1. The dream, the ultimate goal, is T+0, instant settlement. But the level of automation for that is it's a whole other level. And there's a huge reason for this race to zero. It's not just about speed for speed's sake. Every single day that gets shaved off that settlement cycle makes the entire market safer, it makes it more efficient, and it makes it more liquid for everybody. It's probably one of the most important and yet totally invisible upgrades happening in finance right now. So let's recap. The trade is settled, the digital handshake is complete, the risk has been managed. But what do you actually own now? What does being a shareholder really mean today? Yeah, if you're picturing one of those fancy, ornate paper certificates with your name on it, something you'd put in a frame, you can forget about that. Those are basically museum pieces now. In almost all modern markets, those physical certificates have been dematerialized. Dematerialization is just a fancy word that means your ownership isn't a piece of paper anymore. It's a secure digital entry on a company's official share register. That electronic record, which is often held in a central securities depository, think of that as like a master digital vault for all the shares, that record is the ultimate proof that you own a piece of that company. But owning that little digital record, that is not the end of the story, not even close. This is where the really complex, long-term work of financial operations kicks in.
Because the company you just invested in, it doesn't just sit still. No way. The company you've just bought into is a living, breathing thing. It's constantly making decisions and taking actions that can directly and sometimes dramatically affect your investment, long after you've forgotten about that initial buy click. And these events have a name. They're called corporate actions. It could be something simple, like the company paying out a dividend, or it can be something way more complex, like a merger or a stock split. And they come in a few different flavors. And you absolutely have to know the difference here. Some are mandatory, like a cash dividend. They just happen. You don't do anything. But others, especially the voluntary ones, like a takeover offer, they require you to actually make a choice. And if you don't respond, you could be leaving serious money on the table. And these actions are constantly reshaping your investment. A bonus issue means you suddenly have more shares. A consolidation or reverse split means you have fewer, but they're each worth more. And for every single one of these events, there are operations teams working like crazy in the background to make sure millions of shareholder accounts get updated correctly and on time. So from that invisible CCP managing risk, to the lightning-fast settlement, all the way to the complicated world of corporate actions, this hidden machinery of the market is always, always changing. And it leaves us with a big question. As this whole system gets faster and more automated, what new risks might we be accidentally creating? That's a thought for another time.